Hello, everyone. We're just going to give everyone a chance to join quick. Awesome. Well, let's get started. Hello, everyone, and welcome to today's webinar. I'm Katie Kreider, Marketing Manager here at MP. And thank you for joining us for the Big Beautiful Bill, What Employers Need to Know Now. We're excited to have you with us. A few quick housekeeping notes before we get started today. Today's webinar will run about 60-ish minutes, including Q&A at the end. So please submit your questions anytime using the Q&A box, and we'll cover as many as we can before we wrap up. And if we don't get a chance to hit your question, we'll come back around to it and we'll reach out to you personally. A recording of today's session, along with the slides, will be shared with you afterward. And don't forget, all attendees are eligible to receive 1 SHRM credit if you stay with us for at least 50 minutes, and we'll provide details on how to claim that following the session. Before we begin, let me give a quick introduction to MP Wired for HR. MP offers a full human capital management platform: payroll, time, benefits, recruiting, performance management, everything you'd expect from a big box provider. But what makes us just a little bit different is our service and our expertise. We deliver white glove support, 100% on time and headache-free implementation, and a dedicated team of SHRM certified professionals like Paul Carelis who partner with you beyond just technology. We prefer the proactive approach. We help businesses of all sizes not only run payroll, but also solve real compliance and HR challenges before you get hit with the fees. So now on to today's session. We are fortunate to be joined today by Paul Carelis, MP's VP of HR Services. Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and industries, and he leads a team of SHRM certified HR professionals here at MP, assisting clients with compliance, training, and HR guidance across the full employee life cycle. Paul is going to walk us through the bill, what's in it, what's enforceable now, what's still pending, and what steps employees should take to stay compliant and ahead of the curve. So with all of that, I'm going to hand it over to Paul.
Awesome. Thank you so much, Katie. Great to be with you all again. Really looking forward to today's session. I got to say, this piece of legislation is the one that we received the most questions on really in recent memory. Got a lot of publicity, a lot of headlines. So yeah, there's a lot to dive into here. So that being said, I'll get right to it. So what I hope to get covered today, we're going to talk about the bill itself, kind of how we got here, some of the details of the bill. Obviously, the most common questions that we're getting are payroll related, especially around the no tax on tips and no tax on overtime. So we're going to do a deeper dive into that and really explain what it actually means and how it all works. We'll also talk about some other business related items. So from an employment law, benefit, payroll, HR perspective, what are some other relevant things in this it is a big bill, that's for sure. What are some other things that you may or may not have heard about that would be relevant to your business and your industry? We'll also go over a few frequently asked questions, kind of some myths that are out there, some things that people heard about, might have been earlier on in the life cycle of the bill that didn't make the final cut or what have you, but we'll go into some of those frequently asked questions. And as we like to do, we'll end with a little bit of a HR checklist for employers, as well as answer as many questions as we have time for. So looking forward to it today. So, as you saw, as you were following the news, the final version of the One Big Beautiful Bill was passed on July 4th of this year. In order to avoid the filibuster, it was utilized the budget reconciliation process to avoid filibuster and to get this put through. As I said, it is a big bill, 870 pages. There are hundreds of different provisions within it. Everything from the stuff we'll talk about today that's relevant for businesses, things about, border patrol and border spending, Medicare, Medicaid, all that kind of stuff. A lot of things that we won't be covering today that, I highly recommend if you see, other types of experts out there doing presentations, take it all in. There's definitely stuff from a individual tax and accounting perspective that's very relevant. There's stuff from a benefits perspective that we'll touch on today, but certainly, the more information you have, the better. Knowledge is power, but hope to educate you quite a bit with what we'll talk about today. So let's dig right into the biggest headline, the no tax on tips, the no tax on overtime. I do have that in quotes because it is not a full, tax break on all tips and all the overtime. There are some really important intricacies of it that it's important for you to know. And as I'm sure if you have employees who work overtime or if you have employees who receive tips, there are definitely things here that you'll want them to know about. And I'm sure you're getting a lot of questions as well. One thing before I forget, we do have a kind of a one-pager that is employee facing. So if you're getting a lot of questions from your employees about the no tax on tips and or the no tax on overtime, we have designed a kind of a something you can put up in your workplace or distribute to your employees that addresses them directly and how this program will work for them. So let's start off with the tips. In terms of the deduction, it's capped at $25,000. So any tips in excess of $25,000 would not be eligible for the tax deduction. Also subject to some income limits. So for a single filer, if they earn more than their adjusted income is more than $150,000, or if they file jointly is greater than $300,000, then the amount of eligible tax deduction will reduce. It's important to really separate out what is eligible when it comes to the tips. So these are tips and really tips that are at the discretion of customers. So when we talk about that, what counts there? It's when someone decides to, oops, go back there. When someone decides to give a tip or a gratuity. So you go out to eat at the restaurant, you get your bill, it's $50 and you leave a $10 or $12 tip. That is considered a eligible tip for purposes of this tax deduction. Whereas if you do a function, if you have a wedding or an anniversary party and there is an automatic service charge added to your bill, that technically under the way that this regulation is written is not counted as a tip for purposes of this. Also, go to that same restaurant, but instead of 2 of you dining, it's 10 of you dining. And the restaurant has a policy that there's an automatic 18 or 20% gratuity added to parties of 8 or more. Based on how this is written, that would not count towards this either. It's really has to be at the discretion of the diner, the gratuity. So that may be an important distinction depending on how your business operates. You'll also see the term cash tips on this bill, that only cash tips are eligible, and there's been some confusion about that. So to clear that up a little bit, when they say cash, they mean money. So whether it is, actual dollars left on the table, or if it's done via a credit card, that all counts. That's all considered cash tips. They just mean, not something like a service or a physical gift. The value of that cannot be deducted as part of this program. It has to be actual money that's given as a gratuity or a tip, not an item or a service. So in terms of who's eligible to take advantage of this, they use the term, occupations that customarily and regularly receive tips. They have not gone so far as to define that just yet. We will see, I would estimate in the next month or so. There are departments within the federal government that have been tasked with coming up with an actual list of what occupations are eligible. So you'll definitely see things like wait staff and bartenders, hairstylists, things like that. It'll be interesting to see once this list does come out what qualifies and what doesn't. There's certainly some gray area. There's certainly some industries and occupations in question here. So that is something that we don't have concrete information on just yet, but hope to really soon. A few other items. So you will see this on the overtime provision as well. In order for an employee to be able to deduct this or use this tax deduction, in terms of their employment, they'll need to be receiving a W-2 with their Social Security number, or if they're a 1099 filer, they need to have a Social Security number on file. So if you have workers and employees using a tax ID number instead of a Social Security number, they will not be able to claim this deduction. Um, a little bit of good news for certain employers out there. If we have anyone in the hair or beauty industry, you may not be familiar with the FICA tip credit. This is something, if you're a restaurant, you're hopefully familiar with, but the FICA tip program, or the tip credit program, allows historically restaurants and hospitality to get a tax credit for the Social Security and Medicare taxes that they pay on tips once minimum wage threshold is met. So if you have a server who, after tips, is earning the equivalent of $30 an hour, the restaurants can get a tip credit on the Social Security and Medicare tax for some of those excess taxes on the tips. Again, that had been restricted to kind of the food service industry. Under the One Big Beautiful Bill, salons, barber shops, nail places, things like that will now be eligible to take advantage of the FICA tip credit program as well. So that's some good news. When it comes to how this is handled from a payroll perspective, as of right now, guidance from the IRS on the way that this program is designed, there should not be any changes to payroll, to withholdings, anything like that. This is not an immediate tax exemption. This is a deduction that employees can claim when they file their personal taxes early next year. When they do that, that's where they realize this deduction is not something instantaneous where that money is not taxed. And in addition, this tax deduction is strictly for federal income taxes. State income taxes are still applied to tip income, as well as Social Security tax, Medicare tax, any other relevant taxes. This is strictly no federal income tax on these selected tips. Okay, so next we'll move over to the no tax on overtime. This similarly has a limit on how much the deduction can be. So for a single filer, they can claim a tax deduction of up to $12,500. For folks who are filing a joint return, the maximum overtime deduction is $25,000. This is also subject to the same income limits as the tip provision. So 150K for a single filer, or 300,000 for a joint filer. One thing that's really important here in talking with businesses has thrown them for a bit of a loop. This is the only overtime that is eligible for this deduction is weekly overtime required by the Fair Labor Standards Act, which means when you work more than 40 hours in a work week, if you're a non-exempt worker and you get time and a half, those are the situations, and that is the type of overtime that is eligible for this deduction. If you happen to have employees in a state that has a different overtime requirement, so we'll go over that in a minute when we look at some examples, but California always comes to mind. So for those of you unfamiliar with California labor law, in the state of California, when an employee works more than 8 hours in a day, those additional hours are to be paid at an overtime rate. Obviously, that is not the law across the country. And when it comes to the tax deduction and the no tax on overtime, it's strictly the federal rule. So that California example, provided they work fewer than 40 hours in a work week, that would not be eligible overtime for purposes of this deduction. Also, if you have a company policy, maybe you pay time and a half on certain days or on holidays or do double time, whatever it may be. Outside of that, more than 40 hours in a work week, those overtimes would still be fully taxable as well. Another thing that's really thrown a lot of businesses for a loop that's really important to understand is that this tax deduction only applies to the overtime premium. So I'll go over that in some more detail on the next slide when we go over some examples. But when we talk about time and a half for overtime pay, it's just the half portion of that that is eligible for a tax deduction. Again, to make it a little bit more clear, we'll go over some examples in a second. Much like the tip provision, they also need to be utilizing a Social Security number. This will show on the W-2, more on that in a moment. And they also have provisions in here to prevent double dipping. So if someone is working a tipped position and also getting overtime, those calculations are going to get really interesting and complex. So definitely work with someone on those, especially the first time around, in terms of how that's all allocated. But you cannot claim, the exemption or the deduction on both the tips and the overtime if it's the same dollars. So you got to be really careful navigating that. All right, so let's go over a couple examples here. So our first employee is Jason. Jason earns $20 an hour, works in Indiana without any kind of state specific overtime provisions, and he works 50 hours in a given week. So in Jason's case, he worked 40 hours at $20 an hour, and then he gets time and a half for those additional 10 hours. So $30 an hour for those 10 hours. So his total pay for his regular time and his overtime is $1,100. His overtime pay is $300, but the amount that's eligible for the no tax on overtime tax deduction is just $100. So again, he got the straight pay of $200 for those 10 hours, and that 0.5 additional premium, which makes up $100 of his overtime pay, that's what's eligible for the deduction, not that full 300, just the half of the time and a half. Looking at another example, we've got Josh, who's also a $20 an hour employee, but he's in California. He worked 4 10-hour shifts in a given week. So because each of those shifts were 10 hours, each of those shifts triggered 2 hours of California overtime. So while he has 8 hours of time and a half, because he didn't work more than 40 hours in the work week, Josh is not eligible to deduct any of that from his taxes under this overtime provision. Looks like this cut off. All right, I got it on the next slide here. Then we've got Anthony. He's also a $20 an hour, employee in Massachusetts. Anthony worked 45 hours over the course of the work week. 8 hours of those were paid at time and a half because 8 hours were worked on Sunday, and the company has a policy that they pay time and a half on Sunday. Just a shout out to the previous blue laws that are no longer in effect. RIP. So in Anthony's situation, his total overtime pay for that Sunday was $240 for the 8 hours at time and a half. But he does get some credit for that because he did work more than 40 hours in the work week, but it's only those 5 hours that were over 40 that would be eligible. And again, only the half time. So in Anthony's case, he's only eligible for $50 deduction of overtime pay. I know these can be confusing. We will make sure you get all copies of these slides. And as Katie said, please reach out if you have questions. This can get tricky, especially when we talk about exempt workers and tipped workers and all of that. It can get quite complex. So we're definitely here to help you with these. But for my final example, we've got Jennifer. So she is a $1,200 a week exempt manager. She receives incentive pay that equals $30 an hour when she exceeds 40 hours. So she's exempt. She's not required to have overtime, but as an incentive, when she works some extra hours, they give her an incentive pay that's basically the equivalent of $30 an hour. So last week she worked 50 hours. In this situation, her total pay, including her incentive pay, was $1,500. But because she's an exempt worker, and that means exempt from the FLSA and exempt from the Fair Labor Standards Act, none of that pay is eligible for this overtime tax deduction. So they've made it clear that it's strictly a FLSA. If you do anything above and beyond what the federal law requires, even if you are required to do it because of state or local provisions, that won't fly when it comes to this deduction. Okay, so moving on to the IRS here, obviously they play a big role in how this is all going to work. I believe it was on August 7th of this year. So just a couple weeks ago, they came out with a statement and a release saying that there were not going to be any changes to the W-2 or the 1099 or the 941 this year. They're going to figure out a way to help employers comply, but they weren't going to be making any changes to the forms. I don't know what happened behind the scenes over the 7 days that followed, but all of a sudden last week they came out with a new statement that said, well, actually, we are going to make some changes here. So um, they're they are going to require employers list qualified, again, that stuff we just talked about, qualified tips and overtime in box 12. Um, as of right now, there's going to be a code TP in box 12 for qualified tip income, and then code TT will be used for qualified overtime income. There's also going to be a new box on the W-2, at least as of right now, and there was a draft copy that was shared, and certainly these things can change, but there's going to be a box 14B. And what that box is going to be used for will be to put in a code, and these codes have not yet been released, but this is going to be specifically for employees who are receiving qualified tips that may be able to be a tax deduction under the no tips on overtime provision, for you to list what their occupation is to meet the requirements of those eligible occupations. The IRS has said that list of codes will be coming out by October 2nd. Interestingly, the division in the government that was required with coming up with the list of allowable occupations had till the end of this year. So I don't know if that means that they're going to have their work done by October 2nd, or if the IRS is going to fail to meet that deadline. We'll see. But we've got a couple very different deadlines in play here. We'll see how this all plays out. But presumably by the start of October, we should have an idea of what occupations are going to be eligible for the no tax on tips provision of the One Big Beautiful Bill. One term here that might be familiar to employers out there, especially if you've been filing ACA for a while, is transition relief. So if you recall, for the first several years of the Affordable Care Act, the IRS exercised what was called transition relief, which provided certain leniency and respect to good faith efforts on reporting for the Affordable Care Act. That has now gone away in terms of the ACA. So hopefully you haven't, but you may have received some letters, inquiries, audits, penalties regarding the ACA because transition relief is no longer in place. They did announce that for this year in particular, when it comes to the no tax on tips and the no tax on overtime, there's going to be some transition relief. So exactly what that is, we're still working on determining and creating some best practices there. But whether it's the IRS themselves, employers, or even those of us who are in the payroll industry, this is going to be a tricky first run. This is something where the law passed in July. This specific provision or provisions are retroactive to the beginning of 2025. So it's always tricky from a tax perspective to go back in time. Never something we ideally want to do, but this is in place now. So we'll see what that transition relief looks like closer to the end of the year, hopefully sooner rather than later. But all of us here at MPHR will be ready to advise accordingly. Another important thing here is that for both of these go from the 2025 tax year through the 2028 tax year. So when it comes to strategy, and we'll talk about that shortly, this may or may not go beyond 2028. If things just stand pat and there aren't additional bills passed or regulations passed, then this will revert back to how it was previously after tax year 2028. So definitely something to keep an eye on if that changes or is allowed to expire. So some other relevant positions from a HR and employment law standpoint. Another provision that you probably heard about was the no tax on Social Security. You may be wondering, why are we talking about this? We're talking about employment law, not retirement law. Well, when they say no tax on Social Security, it isn't actually changing the taxation of Social Security. That has to go through a different mechanism through this bill and the budget reconciliation process. They weren't really allowed to actually affect how Social Security is taxed. So what they did as a kind of workaround was they created an additional tax deduction for seniors and their spouses 65 years of age or older. So what this did was created a new tax deduction. So whether their income is coming from Social Security, a pension plan, or, as we see more and more these days, we have older workers in the workplace. We've got some clients who have four different generations all working under one roof. So definitely more common than in times past to have employees who may be 65 or older. And so depending on their income, they may be able to take advantage of this and get a decent tax break, even though they're still actively employed with you. So again, no requirement that the tax deduction be applied to Social Security income. There is just the income limit of $75,000 for a single filer or $150,000 for a joint filer. If they earn more than that, that will affect their eligibility for this, or the amount they're able to deduct. But this is in place and should apply to your employees who meet that age requirement. Similar to the tips and the overtime, this also is written as a temporary program through tax year 2028. So barring any further action from the federal government, that this will sunset at that time. All right. Also, for those of you who use independent contractors, or if you have gig workers or do online commerce, whatever it may be, if you're someone who tends to issue 1099s, there are some important changes there as well. So for 1099 miscellaneous and 1099 non-employee compensation, starting next year. So it's not for payments that are being made in 2025, but starting with payments in January 1st, 2026 and beyond. You're probably familiar with the $600 reporting threshold, where if you pay an independent contractor more than $600 over the course of the year, you're expected to issue them at 1099. That threshold is going to increase from that $600 all the way up to $2,000. So what that means is if someone has legitimate independent contractor income from you that's less than $2,000, you will not be required to issue them at 1099 miscellaneous. Also, that number in terms of what that threshold is going to be indexed based on inflation starting in 2027. So that threshold will likely go up as the years go on. For anyone issuing or receiving 1099Ks, so those are for your gig workers. Those are the 1099s issued by PayPal and Venmo, Uber, all that kind of stuff. That threshold that had come down pretty significantly over the last few years, so it's reverting back to a $20,000 and 200 transaction threshold. So this is kind of a both thing, where in order for a 1099K to be required to be issued, excuse me, the worker, the contractor would need to receive both $20,000 in income and have 200 transactions. Again, whether that's eBay sales or DoorDash deliveries, whatever it may be. Also, some changes related to childcare. So first, for those of you who have an FSA plan that you offer to employees, starting next year, the dependent care FSA maximum will be increasing fairly significantly. So right now, that maximum is $5,000. So that's the amount of money that employees can set aside as a household to defer costs of daycare and things like that. Starting next year, they'll be able to put aside up to $7,500 instead of that $5,000 current maximum. And not quite as common as dependent care FSAs, but for employers who do provide childcare directly for their employees, again, probably not as common as it once was. I know my wife was someone who was able to attend childcare when our parents worked at a facility. Not quite as common as it used to be, but definitely still exists out there. So there are existing tax credits for that, for employers to be able to claim if they provide childcare to their employees. Those credits are increasing and some of the rules are being kind of loosened or expanded. So right now, the maximum tax credit is 25%. That's going up to 40% or 50% for certain smaller employers. So they're really trying to incentivize qualifying small employers to offer this type of childcare. So they're giving them some larger credits here. And then the maximum amount of the employer provided childcare credit is also increasing really significantly. So the maximum had been $150,000. Now businesses can claim a credit of up to $500,000, or if you're one of those qualified small businesses, up to $600,000. In addition, and this is a big one, for companies who decide to contract with a third party to provide the employer's provided daycare or childcare, they are now allowed to still take advantage of this credit. There were a lot of restrictions that basically prevented third-party administrators from being eligible to be the provider. That is now allowed under the changes in the provision under the OBBB. Also, some expansion for tax credits involving paid family medical leave. So businesses had, up until now, been able to receive a tax credit when they replace the wages of employees out on FMLA. There was a lot of red tape. There were a lot of restrictions. In most cases, employers were not able to take advantage of this. So what they did with the bill was really expand the eligibility for this. So before, I believe the eligibility requirement was that the employee had to be employed for at least 12 months. Now, if the employee has been with you for at least 6 months, they're eligible, or you're eligible, to receive a credit on the wage replacement you provide. There is also, to be eligible for this, the employer needs to be replacing at least 50% of the employee's standard pay. If they go beyond that 50%, the credit, or the percentage of credit that they're allowed to claim, increases as well. One really big thing, especially for those of us who are operating or have employees in states with mandated PFML programs. I sit in Massachusetts personally. We have a pretty robust PFML program here. So under the changes to this provision in the bill, employers can now claim this credit on wage replacement happening through PFML, as well as the premiums that they pay towards PFML coverage for their employees. So this is pretty significant. Before, it was really you had to have your own plan, kind of company sponsored, where you replace pay. But now, whether it's state or local, if you have a required PFML, you can take advantage of this credit as well. This is something, again, that won't affect payroll necessarily, but definitely something to talk to your accountant about. It might be something you can really take advantage of, especially if you're in a state that requires PFML. Another big one here. So this is something that had existed previously, but a lot of employers either didn't know about it or weren't taking advantage of it, or maybe they were scared off because it was set to sunset at the end of this year. But the One Big Beautiful Bill made it permanent. So similar to tuition reimbursement programs that allow you to provide up to $5,250 to employees tax-free for tuition reimbursement, employers can also provide that amount of money to an employee tax-free for student loan repayment purposes. So this can be a really great incentive if you're in a competitive industry, if you're having trouble finding top talent, especially if it's college educated talent that are likely to have student loans in place that they're struggling to repay. This can be a really great benefit to offer and can really make you very, very competitive. So again, you're allowed to use that $5,250 tax-free limit towards student loan repayment rather than actual tuition reimbursement. This is another amount that's going to be indexed for inflation starting in 2027, so you'll likely see that number rise. The one thing which you should have in place if you're doing any kind of tuition reimbursement, student loan repayment, anything like that, any type of education related payments or benefits to employees, you do want to have what's called a Section 127 plan document in place that just goes over the the ground rules for the program, eligibility, what have you. Definitely something you can talk to us about if you're in need, but you do want to have a plan document in place just to make sure that it's compliant, because where it is a tax-free benefit, you got to follow the rules of the IRS. They want to know that you're doing it without discrimination or anything like that. Also, some key changes to the Affordable Care Act. So a lot of these didn't get as much publicity, but come the end of the year, and as we get into ACA season, as these take effect, whenever they do, these will have some impact on the ACA and on employers. So historically, when people went to one of the exchanges, healthcare.gov, or one of their respective state exchanges, once they entered in their initial application, they were generally good, either, you know, on an ongoing basis or at least for a period of time. Under the provisions of the One Big Beautiful Bill, uh, employers are, or rather employees or anyone who goes to the exchange is each year going to have to add in their information, their eligibility, especially when it comes to subsidies and credits. They're going to have to re-enroll every year. What that also means is there were some plans that were set up for automatic renewal. So if you did nothing, you would be renewed in that same plan for the following year. They are going to be ending the automatic renewal. So folks are going to have to go in, select the plan all over again, fill out all the information. There's not going to be anything automatic. If they fail to do so, they will be dropped as of the new year. They're also going to be shortening the open enrollment period on the exchanges, so that it typically run until January 15th. I don't believe it'll be this year. I believe it'll be for the following year. I'll double check on that. That the open enrollment period is going to end on December 15th. So they're cutting a month off of the enrollment period on the health exchanges. So definitely something to be mindful of, something where you may have some folks. I think I read something that said 40% last year of people who signed up for an ACA plan signed up after December 15th. So we'll see what comes out in terms of notification for folks and, any announcements or publicity around it, but that is a pretty significant change. Also, historically, when someone had a kind of a mid-year eligibility, they lost coverage somewhere else and needed to hop on an exchange plan, there had been a 90-day grace period. So people got signed up, they got covered, they got a subsidy on their premiums, and then had 90 days to provide proof for eligibility for subsidies, those income guidelines and what have you. There's no longer going to be that grace period. So if folks are looking to qualify for a subsidy or a credit on those monthly premiums, they're going to have to submit the substantiation information at that time. And also, we've got some premium tax credits set to expire. So some of those plans may become more expensive once that happens at the end of this year. What that means for employers, you may have seen a decrease in the amount of employees hopping on your group health plan if you have one, because they were getting more favorable rates under the health exchanges on the Affordable Care Act. You may see that reverse, and you may see more folks coming on the group health plan if it makes more sense for them. Again, statistically, that remains to be seen. Obviously, a lot hinges on how the rates change on the exchange, as well as what your rates are and what the plans you offer are, but definitely something to monitor as the months and years go by here. Some other provisions that are relevant for employers that I wanted to make sure we talked about a little bit. Not commonly used in the world of transportation benefits. So for those of you who may not be familiar with commuter benefits, that falls under section 132 of the IRS code. So you may know that as like transit passes. Some people call it commuter FSA, but the most common uses of that are when an employer either provides the means on a tax-free basis to get monthly, train or subway passes for folks to get to work, and the tax benefits associated with that. There's also some parking that can be provided on a tax-free or tax-advantaged basis. There was also much less used, up to $20 a month tax-free for folks who use a bicycle to get to work. That piece, the other pieces of the transit, Section 132 are remaining, so you'll still be able to have, subject to the monthly maximums, the commuter rail, the subway, the parking, all those are remaining in effect. It's just the bicycle, the $20 a month that is eliminated under the One Big Beautiful Bill. Something that hadn't been around for quite a number of years now was the tax-free qualified moving expenses. So that had been suspended. Again, that was a temporary suspension. What the One Big Beautiful Bill did was make that suspension permanent. So outside of military situations, moving expenses will be subject to tax when an employer provides moving expenses to an employee. That will be taxable income. Another thing, and this is something that probably requires a deeper conversation. If you have questions on it, please reach out to us. What was eliminated in terms of employer provided meals was when an employer gives free food to employees, whether that be, you know, comped meals in a restaurant setting, or if you have a cafeteria in an office and you provide free food to the employees in that cafeteria, those type of on-site employer provided meals had been an allowed business deduction on the taxes for companies. That is going away mostly. And I've got mostly on there. There are some exceptions to that. Folks on fishing vessels and oil rigs and things like that, where the employer provides meals, those are still eligible for the tax deduction. And this doesn't affect other meals and entertainment expenses that employers have previously been accustomed to. Those remain in effect. This is more, as I said, for the on-site, providing food to employees at no cost and claiming a deduction on that. That's going away. Also, in the realm of employee retention tax credit, hopefully, if you filed this, you've received your money already. I do know, because I've worked with many, many businesses on ERTC, there are still a lot of folks waiting for those checks to come in. Provided you filed before January 31st of last year, there's nothing to worry about. You will presumably still have those processed and get those checks in the mail. If you did file late after January 31st, for Q3 and Q4 of 2021, they kind of retroactively canned it as of January 31st. So what that means is if you submitted amendments on your 941 after that date, specifically claiming credit on Q3 of 2021 and Q4 of 2021, those will be found to be disallowed. The Q4 is very, very rare. It was really only new businesses that were allowed to claim ERTC for Q4 of 2021. So that, again, that's very rare. The Q3 is a little bit more common. Out of all the quarters of ERTC, it is the least common, just because so many of the restrictions in place for COVID were no longer in place by Q3. So the impact on that should be somewhat minimal. And again, hopefully everyone got their ERTC filed well ahead of January 31st and have nothing to worry about. And I hope you all get your funds soon if you are still waiting. All right, on the benefit side, health savings accounts, there were some significant changes to those as well. For those of you unfamiliar, health savings accounts is a savings vehicle, tax-free for employees to set money aside for certain healthcare expenses. You do generally have to be in a high deductible health plan to be able to contribute to an HSA. They kind of made it a little bit easier to understand which types of plans are eligible for this, especially on the exchange. So as of now, all bronze level plans will be eligible for HSAs. You don't have to worry so much about what the deductible is on that. They all also made telehealth expenses eligible. That is something that had gone back and forth on. So if you use telehealth, the fees that you have to pay towards that are, you can use HSA dollars on. And then for folks who use direct primary care, those services are also HSA available under the new bill. For those of you who bring in employees on visas, H-1B, any of these types of programs, in the bill there were some significant changes to some of those related document fees. processing costs and things like that. So if you do use immigrant employees, expect your cost for that to increase. And then also when it comes to things like border security and ICE, there were increases to the budget for immigration enforcement. So in terms of that, do make sure you have your I-9s in good order. If you have folks on temporary allowances, make sure you're keeping an eye on those. And when those expire, make sure that they're being renewed, and make sure when they're not that you're enforcing those policies accurately. So should you ever want an independent audit of your I-9s before ICE does it, that's something that we do as part of our HR services. Happy to help out with that. But just something to be really mindful of. We're seeing a big uptick, as you can imagine, in immigration enforcement. So something you want to take seriously and make sure you have in proper order. Another thing, 529 funds, which you may be familiar with, that have traditionally been used as vehicles for pre-tax college savings. They did expand the use of 529 funds to include vocational programs, licensing tests, and credentialing courses. So if you have people in your workforce that still have 529 plans and $529 available, they may be able to use those towards things that are relevant for your line of work. Also, this can be mentioned in the recruiting process as well. For folks, if you're looking to increase your talent pool, getting it out there that folks can get maybe a required skill that they need to have to work for you, that they can use 529 funds towards that. All right, so let's talk about some frequently asked questions. We're seeing some employers, especially the more creative ones, say, hey, I've got this $75,000 a year employee. They're pretty consistently working 50 hours a week. Would it be advantageous for me to make them non-exempt, still pay them maybe a $50,000 salary, let them work that other $25,000 in overtime pay? Doesn't affect me any, gives them $25,000 kind of in a tax deduction and help them out. So not a decision you want to make lightly, not a decision you want to make quickly, something you really want to strategize on. So among the considerations for that, you definitely want to take a look at the deduction limits, the consistency in the schedule. If you're changing someone from exempt to non-exempt, can you really guarantee that you're going to have those overtime hours on a predictable schedule? Also, you want to keep in mind household income limits. If they have a spouse or partner and they file jointly and that person earns a lot more, that may set them, out of whack with the income limits for this program. That might be another consideration. Also, if you move from someone from exempt to non-exempt, that might be a hit to their morale. It also is going to require you to start using timesheets and record keeping and all of those kinds of things as well. So you also want to make sure there aren't eligibility issues, in terms of jeopardizing other non-exempt roles at the company. And then, as I said before, this is something that's set to sunset at the end of 2028. So just be prepared that whatever arrangement you do come up with, if you decide to do this, that it may not be as viable as it was once 2029 hits. Getting a lot of questions about AI provisions. So something that was getting a lot of publicity as the bill was being negotiated in the House and then in the Senate was this rule that the language of it changed from house to house, but was basically that if a state passed a restriction on AI or any type of regulation that restricted AI, that they were going to lose some sort of federal funding. So if that had been enacted, we would have definitely expected a freeze in new AI regulations, but that did not end up in the final version of the bill. So what that means is for states that have been talking about it, and even for those who haven't been, we are keeping a very close eye on state legislatures and whether they pass AI related laws, because there is nothing stopping them from doing so any longer. It will not affect any of their federal funding. So definitely something to keep a really close eye on. The Colorado one that had been passed previously is coming up on its enaction date. I know that the governor had called kind of convening the House and Senate to talk about it a little bit. So there may be some changes coming to it. We'll see. But I certainly expect to see more states adopt some AI regulations. So that's something you want to stay tuned to us for. We'll give you the latest on that as it happens. All right, ICRA. So for those of you unfamiliar with ICRA, ICRA stands for Individual Coverage Health Reimbursement Accounts. And these are becoming more and more popular. This is an alternative that a company of really any size can use as an alternative to a traditional group health plan. And without, I know we're running short on time, but basically it's a way for employers to give employees an allowance or a amount of money that they can then use to take that allocation and apply it to a health plan on the exchange. So it gives employees the option to pick whatever type of health plan is best for them. They're not bound to choose yes or no to the employer plan. And especially for smaller employers or more limited employers, they may only have one plan to offer their employees. And as we said before, you may have teenagers that are working for you, and you may have senior citizens working for you. And the best health plan for those two individuals may be very different. So the ICRA definitely gives some flexibility. It also insulates employers from the rising cost of group health plans. Again, this is something to really talk to your broker about in terms of what's the best fit for you. As the popularity of these programs increase, and one of the preliminary versions of the One Big Beautiful Bill were some significant changes to ICRA. Now, those provisions did not pass, so there were not changes to ICRA laws within the One Big Beautiful Bill. But depending on what the legislature thinks, it could very well come out as its own piece of legislation. We don't know yet. We'll see. In case it does, I did just want to share what had been proposed in case we see it again so that we're all kind of see it coming a little bit. So the first thing was a rebranding, and I don't have it in front of me, so I don't remember what the acronym stood for, but the name ICRA was going to be changed to choice arrangements. So it had to do with employer flexibility and whatnot. But the name of ICRA is going to be changed to choice arrangements. It was also going to allow employee contributions for whatever they had to kick in for the plan that they chose to be pre-tax under Section 125 rules, and also allow an employer tax credit for their contributions for what they provided under the choice arrangement. So again, this did not pass. ICRA is the same today as it was, several months ago before this passed, but this is something to keep an eye on in case it's introduced as a separate piece of legislation. All right, so checklist for you as employers and HR professionals. First, you want to examine how you're reporting tips and overtime and payroll. You might need some additional categories. Again, there's going to be some transition relief here this year. We'll see what that looks like. I'm not too worried about this year. Definitely something to at least have a chat with your payroll folks internally, as well as your payroll company when the time comes. As a payroll company, we're waiting for further guidance from the IRS. We really need that before we can advise. But if you do have a situation where you pay overtime for more than 40 hours, and maybe you, again, have a company policy where you pay overtime in other situations or have state mandated overtime, you might want to start strategizing on how to report that and maybe report it a little bit differently. Same thing goes for tips. So if you have everything going into one tip category, including mandatory service charges and automatic tips and things like that, you really, and maybe this is for 2026 realistically, but as soon as possible, you want to start developing systems where you're separating out those tips from ones that are eligible for this program against ones that are not. Definitely provide some employee education. This is for your benefit, I'm sure. And I know just talking with businesses, a lot of people have just been peppered and peppered and peppered with questions about, hey, this bill passed. Why do I still see taxes being taken out of my tips, taxes being taken out of my overtime? So any education that you can provide to your employees will lessen the administrative burden on you as an employer. So again, we've got that document available. Encourage you to utilize that. If you are thinking of making some changes, much like we talked about before, really take some time, examine your job roles, examine your job descriptions, think about strategy. Our HR partners here at MP are well equipped, happy to strategize with clients and business owners about what's best for them. I don't think there's any one easy solution. It's really going to matter on all the variables in your industry and your occupation and the employees that you have. So this is really a on a case-by-case basis what the best decision is, but definitely something we here at MP are happy to talk about. When I tell you I only scratched the surface again, this bill is over 800 pages. So much of it has to do with tax provisions. There are a lot of business tax provisions I didn't touch upon, especially if they're not related to HR and payroll, but there's a lot here. So I certainly feel for our accounting and CPA community. If there's any of you out there, my heart goes out to you. Um, there's a lot. So definitely allow for additional time, both for your business taxes and your corporate taxes, as well as your personal taxes. There's going to be some new wrinkles here. Start talking to your CPA now. There's a lot of programs. There are probably a lot of different ways that you may be able to save on your tax burden. So have that conversation now. It's never too early. The worst thing you can do is start talking to your CPA come April. Their heads are going to be spinning. They're going to be super busy. So now's a really good time to start those conversations, start your planning, start your strategy. Same thing goes for HR and payroll. Let's have these conversations now so that you're feeling prepared. And while we have a little bit of downtime, we can help you out and make sure you're set up for success. This one's very important. Stay tuned for changes, departmental updates. Um, there's been a lot pinned on agencies, whether it be the IRS or the Treasury Department. All different agencies have different due dates and things that they need to complete as part of the One Big Beautiful Bill. So a lot of balls are still up in the air. We don't know how certain things are going to land, what things are going to look like, how things are going to work from a best practices perspective. So this is something that we eat, breathe, and sleep. So stay tuned to us. We'll keep you attuned to all the latest. We're always thinking strategically and how we can best position our clients to optimize some of these things. Some of these things are great things that you're going to be able to take advantage of. Some of these things may sting a little bit, but we'll do our best to minimize the pain. And at the end of the day, we're here for you. So keep close to MP and we'll make sure you're doing the best you can with all of this. All right, so let's see, what do we got for questions here? All right. Is it all or nothing when it comes to the wage limits? Those who earn higher than the wage limit, they get no deduction, or is a sliding scale? So it is a sliding scale. I believe it's for every $1,000 over those limits, it reduces. So in most cases, it is a sliding scale. It shouldn't be an all or nothing. Can we get credit for an employee on FMLA when they use their paid time off or vacation? That's a good question. So we'll have to see what the final guidance looks like from the IRS on that. I don't believe that that's been disclosed within the bill itself, so we're awaiting some further guidance on that. Great question. If you have a spouse that worked for the government and is salary, but also regularly works overtime and gets paid for that overtime, are they eligible for the no tax on overtime? So assuming this is all the same job, that would be a no. So if they're exempt, so it depends. If they're salary non-exempt and they're eligible by law for any hours they work over 40, then yes, that would be eligible for the tax deduction on overtime wages. If they're salaried exempt and it's just a governmental policy that gives them overtime and it wouldn't be required by the Fair Labor Standards Act specifically, then no, it wouldn't be. So it really hinges on whether the overtime that they're receiving is mandated by the FLSA or not. Is the student loan repayment have a sunset? So previously it did. It was going to be ending at the end of this year. What the One Big Beautiful bill did, it was made it permanent. So, and another question here, is it limited to certain industries? No. So any employer who's eligible to provide tax-free tuition reimbursement should be eligible for the student loan repayment benefit as well. Does the 14B qualifying occupation code only apply to tips, or is that for the overtime provision as well? Uh, We believe the IRS didn't provide a lengthy statement on this. It's my understanding it's for the tips only. Overtime will not be restricted based on occupation. It's more on whether you're non-exempt under the Fair Labor Standards Act. So that box 14B designation should strictly be for the tips piece. In terms of how the overtime will show on the W-2, whether it should be all the overtime paid or just that 0.5 portion, that's another item that we're waiting for final guidance on from the IRS. Let's see. I know we're up on time. I'm just going to see if there's one more question here. ACA changes with Medicaid plans like Mass Health. A lot of states are stepping in. So in terms of enrollment changes, there are certain pieces of it that will be mandated under the federal law. So in some ways, the states will hands will be tied a little bit, but I know there are some states that are kind of looking for some workarounds there. So that's going to be on a state by state basis. I would definitely say if you are on an ACA plan now, as an individual, do make sure you go in there before December 15th and make sure everything that you need to fill out is filled out. Whatever they're asking for verification is sent off. I wouldn't make any assumptions with that is basically my advice there. And then one more, we've got a lot here, so we will follow up on as many of these as we can later. But for purposes of this session, the overtime deduction is for the employee to claim when they file their taxes, correct? We have some employees that feel overtime should not be taxed up front. So yes, that is correct. You still want to tax it as usual in payroll. This is for them to claim a deduction on their personal taxes at the end of the year, should they be eligible. We'll see. You know, the IRS has been a little bit mum on whether they'll change the withholding tables or if they'll make any changes to any of that or any guidance for employers to set up taxation for overtime pay any differently. Right now, the guidance from the IRS, and you can maybe use this when you get these questions from your employees, is that the IRS has instructed us to tax overtime and tips as normal as of right now. So with that, again, we'll get to as many questions as we can afterwards, but I know we're up on time. Thank you for your time. I'll hand things back over to Katie.
Thank you, Paul. As always, wonderful hearing from Paul and all his expertise. And so we also want to thank you all for joining today. We hope this session gave you some clarity on what's inside the big, beautiful bill, and most importantly, what it means for your workplace. As a reminder, all attendees will receive a follow-up email with today's recording, slides, and then we will also be sending out instructions for claiming your SHRM credit. We'd also love your feedback. So I did drop a link into the chat. Please take a minute of your time and you'll see that survey, and just take a minute to help your input helps us improve future webinars and ensure we're covering the topics you care about most. And if you'd like content from today's session or additional resources, that will also be in the survey that you can let us know. I know we have a no tips on or no tax on tips or OT poster that has the most recent information that you could put up in your break room to help alleviate some of those questions. We could send out at MP. We know you have choices when it comes to HR technology. We provide the same comprehensive payroll and HCM solutions as the big box providers, but what truly sets us apart is people like Paul. Our personalized service and hands-on HR expertise. Our SHRM certified consultants work alongside clients to navigate compliance, training, and the full employee lifecycle, not just system setup. If you'd like to continue the conversation, again, all of that will be in the survey. Our team is here to help you and make sure that you stay compliant and competitive. On behalf of Paul and the entire MP team, thank you again for spending your time with us today, and we look forward to seeing you at our next webinar.